Usually when you look at a mega-cap tech stock, the narrative is, well, it's pretty painfully straightforward. It's either this runaway freight train of growth that you just can't catch, or, it's an aging dinosaur struggling to justify its valuation.
Right. There's usually not much middle ground with those giants.
Exactly. But right now, looking at the tape for one of the most famous companies on the planet, we are staring at this massive, glaring contradiction.
Yeah, the charts right now are just wild.
I mean, we've got a stock that has bounced an impressive 14% just this month, but it remains trapped inside this vicious long-term downward trend.
It's a total paradox.
It really is. We have a company printing unprecedented billions in profit while simultaneously flashing technical warning signs that literally have institutional traders sweating.
Oh, for sure. The institutions are definitely nervous.
So we're posing a pretty provocative question for you today as we look into our sources. Is the recent 14% bounce in Microsoft's stock a massive buying opportunity for an undervalued giant? Or, are we looking at a classic value trap hiding right behind a falling long-term trend right before their critical April 29 earnings report?
It's the absolute definition of a market crossroads right now. You've got the fundamental analysts staring at the balance sheet and the technical traders staring at the chart, and they're basically pricing in completely different realities.
Two totally different worlds.
Exactly. We're looking at a collision between the underlying business engine and active market sentiment.
Before we jump into all that data, a quick reminder that it is absolutely compulsory for you to leave your comments and feedback down below. We want to hear your take on this debate. And please like the video and subscribe to our YouTube channel if you haven't already.
And just to be clear up front, this deep dive is purely for educational purposes. We're just having a natural debate to help you understand the market dynamics, so absolutely no financial advice here.
Okay, let's unpack this. Before we even begin to judge the stock's current price, which is sitting at $422.79 as of April 20th, 2026, we really need to look under the hood.
Yeah, we have to look at the actual money flowing in and out of this $3.14 trillion behemoth.
Right.
The fundamental bedrock.
Right. And the size of this engine is, honestly, it's almost hard to comprehend. Let's look at the annual figures for fiscal year 2025.
The 2025 numbers were staggering.
Microsoft brought in $281.7 billion in total revenue, and out of that, $101.8 billion was pure net income. Plus, they generated a massive $71.61 billion in free cash flow.
I mean, that is just an absolute mountain of cash. Those are the numbers that make fundamental investors aggressively hold their positions.
Yeah, nobody wants to sell that.
Exactly. Delivering over $70 billion in free cash flow, it shows a level of pricing power and market dominance that very few companies in human history have ever actually achieved. It creates this massive safety net.
But, and here's the catch, let's look at the most recent quarterly numbers Q2 of 2026, because the picture suddenly fractures.
It really does. The shift is abrupt.
Revenue was still massive at $81.27 billion for the quarter. Net income remained incredibly strong at $38.46 billion, but the free cash flow, it plummeted to just $5.8 billion.
Which is a huge, huge drop.
Right. Now, I look at the $80 billion cash reserve sitting on their balance sheet, and, that acts like a massive financial shock absorber against macroeconomic volatility. They certainly aren't running out of money.
No, definitely not going broke anytime soon.
But seeing free cash flow drop from an annualized run rate of $70 billion down to under $6 billion for a single quarter, it's jarring. So what does this all mean? With the PE ratio dropping from 35x down to 26.45x, isn't this stock just on a massive discount?
If we connect this to the bigger picture, the divergence between net income and free cash flow there is really the entire story of Microsoft right now.
How so?
Well, net income is an accounting metric, right? It gets smoothed out over time.
Yeah.
But free cash flow is the actual tangible cash left over after capital expenditures.
So the hard cash in the bank.
Exactly. When you see a company print nearly $40 billion in net income, but only keep $6 billion in actual cash, it means they are pouring just an ocean of capital back into hard assets. They're buying servers, land, cooling systems, and GPUs at an unprecedented scale.
Wow. Okay, so about that PE ratio dropping to 26x.
Right. On paper, comparing it to historic highs, the stock is generally considered fairly valued to maybe slightly undervalued right now. But a lower PE doesn't guarantee safety.
Because the market is looking ahead, not behind.
Precisely. If the market believes that free cash flow contraction is going to become a sustained, multi-year trend, then a 26x multiple isn't a discount, it's a repricing. The market is demanding a higher risk premium to hold the stock.
And that tension, that exact repricing fear, brings us to the actual tape. Because, solid financials don't automatically mean the stock chart is healthy. We have to look at how the market is actively pricing this reality right now.
Yeah, the technicals are telling a very different story from the
Okay.
fundamentals.
Totally. If you're trading Microsoft on a short-term basis, things look incredibly bullish. Like we mentioned, it recovered 14% just in April. But zooming out, the long-term trend is undeniably bearish.
It's sitting roughly 20% down from its 2025 highs.
Right. And the 52-week range is incredibly wide, a low of $355.67, all the way up to a high of $555.45. So right now, at $422, we are basically dead in the middle of a consolidation zone.
The moving averages here are fascinating because they show such conflicting momentum. The stock is currently trading above its 50-day moving average of $392.27.
Which acts as a short-term floor, right?
Exactly. But it is entirely stuck below the 200-day moving average of $471.95.
I want to pause on that 200-day moving average for a second because calling it a resistance level feels way too academic. That line isn't just math. It represents a massive graveyard of institutional bag holders.
Oh, absolutely. It's heavy, heavy resistance.
Think about it. Anyone who bought into the hype at the top last year and watched their position tank is now sitting around that 470 level, just desperate to break even.
Yeah, every time the price pushes up toward that line, you're going to see automated sell orders trigger as those funds exit. That is the exact mechanism driving the resistance.
And the technical box is getting incredibly tight, isn't it?
It is. We have trendline support sitting lower at $378.70. But on the flip side, we have that heavy overhead supply. The recent high sits right at $431.58, and there is a major daily trendline resistance right above that at $449.81.
So the stock is just completely boxed in.
Completely, between aggressive short-term buying and massive long-term distribution. And the indicators validate this. The MCD sits at 0.58, which is a buy signal with positive momentum.
Which explains the April bounce.
Right. But we have to warn people, the RSI is at 68.20. That is rapidly approaching overbought territory.
Right as the stock is marching straight into that 200-day ceiling.
Exactly. You combine an overbought RSI with heavy overhead resistance, and you have the perfect recipe for a sharp reversal.
Let's talk about the order flow, because the volume confirms a major move is brewing. We're seeing 48.6 million shares exchanging hands. That is significantly above average.
Yeah, that isn't just retail traders poking around. That heavy volume suggests major institutions are aggressively repositioning before this April 29 earnings report.
And I do want to clarify something. There's been noise about insider selling, right? Like it's adding to the downward pressure. But there are actually no major clusters of insider buying or panic selling.
Right, the high-level executive selling happening right now is just programmatic 10b5-1 plans.
Exactly. It's pre-scheduled. But your point about the institutional volume and the technical setup, is this exactly why retail traders often get trapped?
It is the textbook anatomy of a value trap. Think about the psychological triggers for a retail investor.
They see a famous brand, a lower PE, and a 14% bounce.
Exactly. The natural instinct is to assume the recovery has started, and you need to buy the dip before you miss out. But buying into an overbought short-term bounce, while still trapped under the 200-day moving average, it creates a classic value trap dynamic.
So you think you're buying a breakout, but you're actually just providing exit liquidity for institutions.
Right. You're buying the absolute exhaustion point of these short-term bounce. It carries severe downside risks and volatility.
To truly understand why that technical resistance is so stubborn, we really have to examine the massive weights currently holding the stock price down. The bear case.
Yeah, what could go wrong? And there are some very real structural risks right now.
The primary bearish argument revolves around that capital expenditure. Like we said, Microsoft is spending a staggering $20 billion per quarter. That is heavily pressuring their near-term margins.
It's an incredible level of Capex intensity, and when you combine that with ongoing supply chain risks, it gets scary.
Like the potential hardware disruptions and international tariffs?
Exactly. They are spending billions on specific, highly advanced GPUs and specialized cooling systems heavily sourced internationally. If new tariffs hit those components, that $20 billion could easily balloon to $24 billion just to maintain the same pace.
Which would just further crush their free cash flow. And we're seeing this fear bleed into the analyst community, right?
We are. While the consensus is still a moderate buy, firms are getting really cautious. Major players like TD Cowen and Mizuho recently slashed their price targets from around $610 all the way down to $540.
That's a huge cut for a $3 trillion company.
It is. They're explicitly adjusting their models to reflect these macro pressures. Furthermore, some analysts are actually cutting their revenue estimates for fiscal year 26, dropping from $148 billion down to $144 billion.
But wait, here's where it gets really interesting to me. I want to challenge this bearishness for a second.
Okay, let's hear it.
Wall Street is punishing them for spending $20 billion a quarter. But isn't that just the cost of building the future? Like, are analysts being entirely too short-sighted by demanding short-term margin expansion?
That pushback leads perfectly into the bull case. What exactly is Microsoft buying with that $20 billion every quarter? And could it trigger a massive best-case recovery scenario?
Because they certainly aren't just setting the cash on fire.
Not at all. They are securing tangible dominance in AI.
The numbers back it up. Azure AI is seeing an explosive 38% growth right now, heavily backed by those OpenAI partnerships.
It's massive growth for a company that size.
And it's not just standard cloud stuff. The real bull case points to their expansion into what they call industrial AI. They're developing these new agentic factory systems with Accenture.
Oh, the agentic factories, that is a total paradigm shift.
Right. These AI systems basically act as autonomous supply chain managers. No human input needed to predict machine failures or route physical shipments.
They're embedding themselves directly into the physical economy. The total addressable market there is basically limitless.
And to sweeten the deal, despite all this heavy spending, Microsoft still returned $12.7 billion to shareholders in Q2 of 2026 via dividends and stock buybacks.
Which provides a really nice structural floor for the stock price. It pays you to wait.
Exactly.
What's fascinating here is the bull's timeline. Even with the downgrades, the average analyst price target is still highly optimistic at $577.58.
Which implies a roughly 36% upside from here.
Right. But that bullish thesis hinges on AI monetization completely outweighing those high Capex costs by late 2026. The bulls are targeting a long-term return to 500-plus levels once the heavy infrastructure build-out tapers off.
So we have all these conflicting forces basically on a direct collision course. The explosive AI growth, the crushing Capex, and that tight technical resistance.
It's the short-term mechanics versus the long-term fundamentals.
Let's break down the immediate timeline for the listener. The short-term perspective, meaning the next few days and weeks, it promises extreme volatility around that April 29 earnings call.
Without a doubt.
The stock is testing a falling channel resistance right now. If it breaks above $432, we could see a rapid short squeeze straight up to $450.
Breaking that level forces shorts to cover. But if it fails to break 432,
right. If it fails, the worst-case scenario is a continuation lower. We could easily fall back to test that $378 support floor.
But looking at the medium to long-term perspective, the outlook remains broadly positive as those massive AI investments mature.
It really is the ultimate test of investor patience.
Definitely. And as a brief reminder one last time, this discussion is an exploration of the data, not financial advice.
Absolutely. Do your own research. But as you do, I want to leave you with one final provocative thought to ponder. If Microsoft's AI gamble actually pays off, will today's $20 billion quarterly Capex be remembered as a massive drag on profits? Or, will it be remembered as the absolute cheapest insurance policy they ever bought to secure the next decade of tech dominance?
Something very serious to chew on.
Definitely. Thanks for diving deep with us.